Do you want to earn $24,000 in annual rental income? Do you want an asset that appreciates $200,000 in value? Do you want to master leverage the right way? The answer is simple. Understand the structure of real estate investing. Assess both risk and return. Why does this matter? This slide explains it all. Real estate investing has 5 elements. First, rental income, monthly cash flow. This is the foundation. Second, asset appreciation. The property itself increases in value. However, this varies significantly by market and location. Third, tax advantages. In the U.S., you can depreciate residential rental property over 27.5 years. However, there are requirements, and you must consider taxation upon sale. Fourth, inflation hedge. With a fixed-rate mortgage, the real burden of debt decreases as prices rise. However, rent doesn't always increase immediately. Fifth, leverage. You can control assets with the bank's money. But this is a double-edged sword. You can understand this as the mechanism of real estate investing. However, actual performance varies significantly based on interest rates, location, property quality, and tax laws. Verification of assumptions is essential for replication. So what does it take to make this work? Compare with similar properties in the same market. Always verify payment amounts and cash flow at current interest rates. This enables you to make rational investment decisions. Today, I'll show you the mathematical foundation. First, understand the basic structure of real estate investing. It's a 2-stage subtraction. Stage 1. Subtract operating expenses from rental income. Property taxes, insurance, repairs, management fees, vacancy losses. This total is your operating expenses. Typically, this accounts for 40 to 50% of rental income. For example, if monthly rent is $2,000, annual rent is $24,000. Operating expenses are about $10,000, $12,000. What's left is NOI, net operating income. Stage 2. Subtract loan payments from NOI. This is your final cash flow. Critical point. Operating expenses and loan payments are separate. Operating expenses alone are 40 to 50% of rent. Add loan payments, and total expenses typically become 70 to 90% of rent. If you don't understand this structure, your investment will fail. This is the greatest weapon and the greatest danger of real estate investing. Leverage. You buy a $200,000 property. Your equity is $40,000. That's 20%. The remaining $160,000, 80%, you borrow from the bank. 100% of the property is yours. Rental income, appreciation gains, all go to you. But here's the reality. From 2024 to 2025, U.S. 30-year fixed mortgage rates have been running at 6 to 7%. If you borrow $160,000 at 6.5% for 30 years fixed, annual payments are about $12,000. Annual rent is $24,000. Operating expenses are $10,000. Loan payments are $12,000. Cash flow is about $2,000. Let's calculate ROI. $2,000 divided by $40,000 equals about 5%. Compared to the long-term average return of stocks, there's no significant difference. Leverage amplifies profits, but it also amplifies losses. If vacancy occurs, cash flow goes negative. If interest rates exceed the property's yield, you have negative leverage. Debt becomes a burden. Leverage is a double-edged sword. Understand this reality. Have you heard of the 1% rule? If monthly rent is 1% of property price, it's investment worthy. For a $200,000 property, that's $2,000 plus monthly rent. This is the standard. But look at reality. In many urban areas, 0.5 to 0.7% is typical. Achieving 1% is difficult in many regions, especially in the 2024-2025 environment with high rates and rising insurance costs. The 1% rule is useful as an initial screen, but you can't use it for final decisions. What should you use? NOI and post-payment cash flow. DSCR, debt service coverage ratio. Verify with these metrics, reflecting payment amounts at current rates. The 1% rule is a starting point, not a final decision. Dig deeper into the numbers. Cap rate, short for capitalization rate. It measures property profitability. The formula is simple. Annual net income divided by property price. Here's the critical point. Loan payments are not included. You're looking purely at the property's earning power. Let's look at an example. Annual rent, $24,000. Operating expenses, $10,000. Property price, $200,000. $24,000, $10,000, divided by $200,000 equals 7%. This is the cap rate. However, the fixed view that 7 to 10% is appropriate range is dangerous. Cap rate benchmarks vary by property type, region, and interest rate environment. Prime properties in stable urban areas, 4 to 6%. High-risk areas, 10 to 12%. What matters? Comparison with similar properties in the same market, and incorporating price adjustments during rising interest rates. When rates rise, cap rates face upward pressure. Property prices adjust. Understand this dynamic. Now let's see the complete list of operating expenses. First, property taxes. This varies extremely by region. The rule of thumb, 1 to 2% of property price exists, but states, counties, and cities can deviate significantly. Always verify the most recent tax assessment and amount for the property you're considering. Consider post-purchase reassessment risk as well. Second, insurance. In recent years, insurance premiums have risen sharply, especially in disaster risk areas. About $1,000 per year is outdated information. $1,000, $2,000 plus per year, or even higher in some regions. Always get quotes and reflect them in your projections. Third, maintenance costs. Set aside 5 to 10% of rent. Roof, plumbing, equipment. They will all break eventually. Fourth, management fees. If you self-manage, it's free, but if you hire a management company, expect 8 to 10% of rent. Fifth, vacancy losses. Properties aren't always fully occupied. Budget 5 to 10%. Operating expense ratios vary significantly by property and location. The rule of thumb of 40 to 50% exists, but insurance spike regions, older properties, and HOAs can push it higher. Verify with same area performance benchmarks. This is the tax advantage of real estate investing. Depreciation. In the U.S., you can depreciate the building portion of residential rental property over 27.5 years. This uses the MACRS method. For a $200,000 property, assume land is $50,000 and building is $150,000. $150,000 divided by 27.5 years equals $5,454. This is your annual depreciation. You can deduct this from taxable income. If your tax rate is 25%, $5,454 times 25% equals $1,364. That's $1,364 in annual tax savings. Critical point. This is a paper loss. No actual cash has left your pocket, but your taxes decrease. However, be careful. Depreciation has requirements. And upon sale, taxation related to depreciation, such as recapture, can occur. Personal rentals may also be subject to passive loss limitations. Principal payments build equity while reducing cash flow. Tax treatment of interest and other items requires consultation with a tax professional. Model your exit strategy from the start. Depreciation is a powerful tool, but you can only leverage it by understanding the full picture. Now let's consolidate today's key points. Here's the summary. First, realistic ROI. In the 2024-2025 high-rate environment, $40,000 equity yields about $2,000 annual cash flow. ROI of about 5%. Leverage amplifies profits, but in a high-rate environment, the effect is limited. There's no significant difference from the long-term average return of stocks. Second, the dual nature of leverage. If interest rates exceed the property's yield, you have negative leverage. Debt becomes a burden. If vacancy occurs, if insurance costs spike, cash flow plummets. Leverage is a double-edged sword. Understand this reality. Third, the full tax picture. Depreciation creates $5.454 in paper losses annually. At a 25% tax rate, that's $1.364 in annual tax savings. However, upon sale, there's taxation such as recapture. Passive loss limitations exist. Modeling your exit strategy is essential. Do you understand the reality of real estate investing? Can you assess the risks in a high-rate environment? Share your strategy in the comments. Your investment plan, your questions, your experience. All of this becomes wisdom for this community. Thanks for investing your time with me today. This channel breaks down real estate investing, the power of compound growth, and asset allocation strategies with numbers. I provide reality, not ideals. Math, not dreams. Subscribe to arm yourself with the tools for rational investment decisions. Turn on notifications too. Until next time.